Hello everyone, today is Tuesday, February 3rd, 2026. Hope everyone is doing well mentally and physically. Can you believe 1 month has already gone by in the new year? Well, let's keep it rolling. Welcome to another episode of Tax and Accounting Ride Along, brought to you by Sands Virtual Enterprise, LLC, your go-to dose of straight-talking tax and accounting insights for small businesses and the everyday taxpayer in the general public. Today, we are going to be discussing the advanced expertise and challenges that at times come with individual and business tax preparation. There is this notion among certain business professionals and tax preparers in our industry that seem to think tax prep is simply data entry. Having that mindset can surely lead to typing your way into an audit. So without much further ado, let's crank it up and get straight to it.
You know, there's a phrase that I hear every single year right around this time, and it drives me absolutely crazy.
Oh, I have a feeling I know what you're going to say.
You hear it from friends, you see it in ads everywhere. The idea that tax preparation is, quote, just data entry.
Just put the numbers in the boxes. Yeah.
Exactly. This idea that it's basically just typing. You get a W-2, you find a box, you type the number, and that's it. But we're looking at a source today. It's called Tax Preparation is Not Simply Data Entry Work. And it argues that this mindset is not just wrong, it can be a recipe for financial disaster.
It's a pretty pointed critique of the industry, really.
Yeah.
The author's basically arguing that we've commoditized this skill. Typing is part of it, of course. That's the mechanism. But the real job is strategic. It's about compliance. It's about knowing how all these different codes and forms actually talk to each other.
Right. And if you just treat it like you're typing, you might be typing your way straight into an audit.
That's the core of it. And that's what this deep dive is all about, right?
Yeah, that's what I want to get into, because for so many people listening, especially if you have a business or even a side hustle, the stakes are way higher than just, a refund being a little late.
Mm-hmm.
The source really hones in on where this big picture strategy, the kind you see from influencers online, just crashes and burns against the reality of actual IRS forms.
That is the perfect way to put it. You have these influencers selling what the author calls ideology, do this one weird trick to save thousands, and then the execution falls apart because the person doing the data entry has no idea what the downstream consequences are.
Okay, let's use the first example from the source, because I see this one on social media constantly. It's the strategy of renting your home to your own S-Corp.
Yes, the Augusta rule. It's incredibly popular. And look, conceptually, it is a sound strategy.
That sounds great.
It does. The S-Corp needs a meeting place. It rents your personal home from you. The corporation gets a deduction for rent expense. And under a very specific rule, Section 280A, that income can be tax-free to you as the individual.
It seems like a total win-win. The business pays less tax, you get tax-free money. But the case in the source, it went south fast.
It went completely sideways. And it's all because of that data entry mindset. So the business owners, they knew the big idea, pay myself rent. So they did. And to make it look all official, they even issued a 1099 MISC from their S-Corp to themselves personally.
Which, on the surface, seems like the right move. You want a paper trail.
You do. You absolutely do. But here's the mechanical problem. The second you file a 1099 MISC with the IRS, the computer system, which is called the Automated Underreporter, or AUR.
The matching program.
The matching program. It is now looking for that exact dollar amount to show up as income on the recipient's tax return.
Well, it's just a big matching engine.
That's all it is. And in this case, the owners filed the 1099, but in their heads, the strategy was tax-free income. So on their personal 1040 return, they just left it off. Didn't report it at all.
Oh, no. So the IRS computer sees, $10,000 paid out by the business.
And $0 reported as income on the other side.
That's an immediate red flag.
An immediate automated flag. It triggers a CP 2000 notice. And this is why the author says data entry is so dangerous. A data entry person thinks, okay, expense entered on the business side, I'm done. But a strategist knows if I issue this form, I have to report it on the personal return, probably on Schedule E, and then I have to back it out as a non-taxable exclusion. That way, the computer sees the match.
Okay, wait, pause there. The source says the clients were shocked. They had to report it. But if you report it and then just back it out, isn't it a wash? Like, what's the big deal? Why does it even matter?
It matters because of how the IRS system is built. If you just ignore the 1099, The IRS's first assumption is that you owe tax on the full amount. They're going to send you a bill for the tax, plus penalties, plus interest.
Wow.
And now you have to spend months, maybe even hire someone to fight it, amend returns, write letters. You've turned what should have been a simple tax-saving move into a huge administrative headache.
And you've probably put a target on your back for future scrutiny.
100%. The strategy was fine. The execution, the data entry, failed the compliance test. You have to understand the flow of the forms.
Which brings us to the software issue. The source is pretty blunt on this. It says, tax software is not meant to be a simple data entry tool.
Yeah, that's a direct quote.
But I have to push back a little. I mean, software's gotten really sophisticated, right? It asks you questions, it interviews you.
Yeah.
If it asks, did you receive rent? And I answer it, shouldn't it catch this stuff?
And this brings us to a specific scenario in the source material that I absolutely love because it illustrates just how quickly simple data entry turns into a nightmare.
Oh, is this the referral scenario?
Yes, the real estate nightmare, as I like to call it.
Okay, let's set the scene. A new client calls you up. They say, hey, I've got some property stuff. Here are my reports. Just file my taxes.
Property stuff.
Yeah.
Famous last words. So let's look at what is actually in this client's portfolio, according to the source. First, they have 7 rental properties.
7. Okay, that's a lot, but manageable, I guess.
Sure. But then they have 2 fixed and flipped properties that were sold during the year.
Okay.
Then they have 2 more properties that are currently being renovated to flip next year.
Keep him busy.
And finally, they have 1 property that is just sitting there. It needs minor work, no income, but they're holding it as an investment to sell later.
So to the untrained eye, this just looks like real estate. I put all the expenses in one column, all the income in another, and I'm done.
And if you did that, you would be filing a wildly incorrect, possibly fraudulent tax return.
Really? Why?
Because the source points out that these are 3 distinct activities with completely unique tax treatments, and software won't tell you that. You have to tell the software.
Walk us through the differences.
Okay. Bucket number 1, the 7 rentals. That is passive activity. It goes on Schedule E. The depreciation rules are specific. You report rent. You deduct mortgage interest. The income is generally not subject to self-employment tax.
Got it. Category 1, passive.
Now, bucket number 2, the fix and flips. This is where people get hammered. A flip is not a rental. You aren't holding it for income. You're buying it to sell.
So in the eyes of the IRS,
It's inventory. You are a dealer.
like a grocery store selling milk.
Exactly. That is an active business. That goes on Schedule C or maybe a 1065 or 1120S. The profit is ordinary income. And here is the kicker. It is subject to self-employment tax. That is an extra 15.3% tax on top of your income tax.
Oh, wow. So if I accidentally put that on the rental schedule,
You're underpaying your taxes by 15.3%. The IRS does not like that. And then you have the third bucket, the investment property.
one just sitting there.
Right. Held for the long term, not for rent, not for immediate sale. That's a capital asset.
And what's the trap there?
The expenses.
Yeah.
If you aren't renting it and you aren't a business, you generally can't deduct the utilities, insurance, or taxes right now. You have to capitalize them.
Capitalize means adding them to the cost of the house.
Right. You add those costs to your basis. So when you eventually sell the house in 10 years, you pay less capital gains tax. But if you try to deduct those expenses today on Schedule E, disallowed.
My head is spinning a little bit. We have 1 client, 1 industry real estate,
Yeah.
but 3 completely different tax treatments.
And that's the point. To the client, it's just buying houses. But the tax preparer has to look at the intent and the usage of every single property to decide which form, which schedule, and which tax rate applies.
The source asks a really poignant question here. Does this sound like data entry to you?
It's rhetorical, but the answer is a screaming no. It involves professional judgment. You have to ask questions.
Right.
What was your intent with this house? Did you ever rent this one? Why is this one sitting empty? You are investigating, not typing.
And I imagine if you just plugged all those numbers into TurboTax or whatever, the software wouldn't stop you.
The software will do exactly what you tell it to do. If you tell it that your inventory is a rental, it will calculate a beautiful wrong return. The source explicitly says tax software is there to facilitate efficiency. It is not meant to be a simple data entry tool.
That really drives home why the pricing has to be value-based. You aren't paying for the typing.
Yeah.
You're paying for the person who knows the difference between a flip and a rental.
Exactly.
Now, speaking of what we are paying for,
Yeah.
let's talk about the boundaries of the job. Because there is a second major focus point in our source material that I think every freelancer and small business owner needs to hear.
The boundary between tax prep and bookkeeping.
We mentioned the shoebox earlier. The source brings up the classic shoebox myth.
It's the bane of every tax professional's existence. A client walks in, dumps a literal or metaphorical box of receipts on the desk and says, "Do my taxes."
And the expectation is that the tax pro will sort through them all.
That is the expectation. But the reality check from our expert sources, no.
Hard pass.
We need to be very clear here. Tax preparation does not include bookkeeping. Those are two separate professions, or at least two separate services with separate fees.
So what is the client supposed to do with the shoebox? Why do they keep them?
That shoebox is for the client's records. It's for audit defense. The tax preparer does not need to see every Starbucks receipt or every Home Depot slip. They need a summary. They need a profit and loss statement.
Wait, so if I hand my accountant a box of receipts, they aren't actually looking at them?
If you hired them for tax prep, no. And they shouldn't. If they have to sort through your receipts to come up with the totals, they are doing bookkeeping. And if a CPA or a tax strategist is doing your bookkeeping, you are likely paying $300 or $400 an hour for someone to uncrumple paper.
That is an expensive way to organize receipts.
It's the most expensive way. The source is adamant. We as tax experts don't need to sort through it. Now, there is a caveat. We might ask for specific receipts.
Like if something looks suspicious.
Exactly. If I see a travel expense for $20,000 on a business that makes $40,000, I'm going to ask to see the documentation. I need to verify that before I sign the return. But generally, keep your shoebox at home. Bring me the totals.
Okay, so bookkeeping is separate. That's the past data. What about tax planning? That's the future strategy.
This is another blurry line. Ideally, tax planning, which is looking forward and strategizing, is also a separate service. Tax prep is historical. It's looking backward at what already happened.
Here's what I did last year. Let's file the report.
Right. But the source offers a really generous nuance here. While planning is technically separate, most clients get a freebie benefit during the prep process.
A freebie. I like freebies.
When a competent pro is going through your return, doing that archaeology of your year, they inevitably spot things. They might say, "Hey, I noticed you had a lot of medical expenses this year. Next year, you might want to bundle them differently." Or, "Your business income is getting close to the threshold where an S-Corp might actually make sense."
So that's planning advice, but delivered during the prep meeting.
Exactly. It's reasonable planning shared during the discussion. It adds massive value. But again, it shows why you are paying for a professional. A software program isn't going to look at your return and say, "Hey, based on this trend, you should change your business structure next year."
It's the human element again.
Always.
So let's really cement these takeaways because we've covered a lot of ground.
Let's do it.
First, the big picture advice you see online, like that S-Corp rental strategy, can be dangerous if you don't understand the mechanics.
Check the details before you write the check. If you don't know where it goes on the form, just don't do it.
Second, pricing. If you have a business return, a 1065, an 1120S, and 1120, stop expecting 1040 pricing, you aren't paying for the form, you're paying for the complexity of the organism.
You're paying for risk assessment, industry expertise, and keeping the IRS away from your door.
And third, boundaries. Bookkeeping is your job or your bookkeeper's. Tax preps are the pro's job. Keep the shoebox for your own defense, but don't dump it on your accountant's desk unless you want to pay a premium.
It saves you money and it makes your tax pro actually like you, which is a good thing.
This has been really eye-opening. I think I've finally let go of my calculator and coffee fantasy. It sounds like tax prep is actually, dare I say it, kind of intense.
It is. It's detective work, it's legal compliance, and it's financial strategy all rolled into one. And I want to leave you, the listeners, with one final thought from the source material regarding competence.
Go for it.
You will often hear some tax professionals say things like S-Corps are a scam, or real estate strategies never work, or businesses lose money when they convert. The source challenges us to ask a hard question. Is the strategy actually bad? Or does that professional just lack the depth of knowledge to execute it correctly?
Ooh. That's a spicy take to end on.
It raises a question of competence. If someone tells you a strategy doesn't work, are they analyzing your specific business? Or are they just admitting they don't know how to translate that strategy into a compliant tax filing? It goes back to that green comment. Real pros know how to make the tools work.
So find yourself a pro who knows the difference between a flip and a rental, who treats your business like the complex organism it is and who isn't afraid of the forms.
And seriously, organize your receipts.
Deal. Thanks for helping us unpack all of this.
My pleasure.
Well, folks, that's a wrap. Thanks for joining us for another episode of Tax and Accounting Ride Along, courtesy of Sands Virtual Enterprise, LLC. Got feedback or curious questions? Or maybe a topic that needs some airtime? We'd love to hear from you. Connect with us at admin@sve-accountingandtaxes.com or text us at 404-5858513. Also, follow us on Facebook, Instagram, TikTok, YouTube, and LinkedIn for more insights. Catch you next time for more business talks and good times.